Hello students, now let's practice intangible asset simulation, focusing on the amortization and depreciation journal entries, and we'll complete this the construction of the balance sheet and income statements for the December 31st, year 1. For each situation below, record the appropriate journal entry and create financial statement for Richter Corporation. Assume the company used the step line method for amortization and depreciation, and that all amortization depreciation is recorded on December 31st of each year. That is the most simple the case, the simplest one. And Richter uses separate journal entry account to record accumulated amortization for each intangible asset. Good. That's why here we have the different the book value of the PP&E and intangible asset and the goodwill on the balance sheet. Okay, we have a little bit different format here. The account name on the debit at the top, at the bottom, and on the credit. So you can see it like this. Or if you want to see it more clearly, then I will record in that way. Now, April 1st, the journal entry 1, the year 1, the Richter purchased a patent with a 10-year life for $50,000 from DD Corporation. DD incurred cost $35,000 developing the patent. Okay, so this $35,000 of the development cost of the patent from DD is irrelevant information. They don't care. The Richter company doesn't care about the information, because when the Richter record this patent from this purchase price, which is acquisition cost, they only consider this $50,000 that actually they paid. Okay, so anyway, that is the purchase from the market. So we put the patent purchased the $50,000, right? And then how much they paid? Cash paid on the credit, right? The $50,000, same. Now let's record this, the patent and cash here. Patent 50 and cash out 50. Okay, I know, I understand. The negative $50,000 cash is not in real, but we just assume that we have had the company has had the cash but we want to just record only these transactions. Okay, then we matched out. There's no transactions on the income statement. And Richter purchased the scientific equipment used in product development studies having potential alternative use for future products. The equipment cost is the $75,000, and the company paid additional $4,000 for delivery, which is freight in cost. The equipment has an estimated useful life of 5 years. So now, can we capitalize? Right, because it has potential alternative use for future product. So we put the equipment, how much? 79,000. And then cash paid, the same, the 79,000. So let's report this equipment here before the depreciation. So we still messed out just transaction and exchange between cash and the asset of the PP&E asset, of intangible asset, the patent. So that's it. And October 1st, Richter received an unfavorable judgment in defense of a trademark and paid $25,000 in fees to their law firm. Okay, this intangible asset protection legal fee is $25,000, but the problem is that is the unfavorable situation, that it was under this unfavorable judgment. That means that this cost is just expense that cannot be capitalized. So we should record just legal expense. Legal expense is 25,000. If it successfully defended, then this legal cost can be capitalized as a part of the trademark. Okay. And then just cash on the credit side. So let's record on the cash minus 25, and legal expense here under legal expense minus 25,000, and it should be recorded into here, right? So we matched out 275,000 in total asset and total liability, and equity 275 we matched out. So let me explain this. The operating expense and other expense and loss. The legal expense, amortization expense, or R&D or depreciation expense, those are all the operating expense. Once you calculate the gross margin, gross profit, then we subtract all the operating expenses. But the loss is not the operating part. It is we own some for reaper transaction. The for reaper transaction actually produces some loss, except for the main the operating transactions. And transaction number 4, journalized accounted for the patent purchased April 1st. Now, this is the asset capitalized, so we need to amortize, right? Amortization expense. How much was that? Right, that's the point. We need to get this, the patent, $50,000 patent, and then times, divided by how long years? Let's come back. Okay, 10 years. That has the 10 years life. And then how long month? How it has been, right, purchased on April 1st. So 9 divided by 12 months. So 3,750 is the cost the company should expense. The company should recognize to allocate the acquisition cost of $50,000 of patent. Okay, so we record amortization expense on the debit, and then accumulated amortization on the balance sheet, the same amount. Let's record this amortization expense 3,750 and accumulate amortization the same amount. So we have the book value, carrying value of patent net of 46,250, and this amount should be also the same amount as the retained earning. Okay, and then we found balanced out. And then next, the last transaction accounted for the scientific equipment purchased on July 1st. Now we should adjust. We just adjust this scientific equipment. Now, here is not the last one. Okay, now what account do we need to recognize the first year the use of this equipment? Okay, let me read this. The equipment purchase, the carefully again. Register purchase scientific equipment used in product development study having potential alternative. Okay, so the purpose of purchasing this equipment is for the development, R&D. So it cannot be recognized as the amortization expense. So scientific purchased once they start using this equipment for the R&D development. So we record now, that's correct, R&D expense. R&D expense on the debit. Now how much is that? Okay, 79,000. and then that purchase July 1st. And how long years is the useful life? The 5 years. So 5. How long month? How long month? Right, 6 months out of 12. So 7,900 is R&D expense, not amortization expense, not the depreciation expense for this, because the purpose of purchasing this asset is to produce some R&D studies. So, but in order to allocate the cost of this equipment, now we should use accumulate depreciation. Accumulate depreciation on the balance sheet. Again, this income statements, all the income statement account shows the activity. So what is this equipment activity, right? The R&D expense, right? Not just for the total operating use for the equipment. So we used R&D expense rather than the R&D rather than the depreciation expense. So 900, then accumulate depreciation. Here we put this 7,900. Okay. Now finally, Richter had previously recorded $300,000 goodwill related to an acquisition. At December 31st, year 1, the carrying value of identifiable net asset acquired exceeded their fair value by, now the carrying value is greater than the fair value by $50,000. So the company should record loss on goodwill for impairment. So the total amount $50,000, which is given. Then goodwill directly impaired on the journal entry of the credit side to reduce the asset value. So 50,000. Then goodwill impairment minus 50 on loss. And then goodwill should be reduced by $50,000. Then we balanced out. Okay. So we completed this intangible asset simulation for amortization, depreciation. Okay, see you in the next video clip. Bye-bye.